the Advanced Partners webinar called Mergers and Acquisitions in the Staffing Industry. We are honored to have a close industry friend, Akash Taneja, with us from Momentum Advisory Partners. Before we get started, we just wanted to go over a couple of housekeeping items. Erica, the floor is yours.
Thanks, David, and welcome everybody. Thank you for joining us today. A couple housekeeping items. First off, this webinar is being recorded, and the presentation will be sent to your email via a post-event link for you to access as you need. There will be a Q&A session at the end of the presentation. Should you have a question for the speaker, feel free to drop it in the Q&A chat window located on the right hand of your screen console. There is a Learn More section where you can download a PDF version of the slides for today's presentation. There will be a survey at the end of this webinar, so we ask you to stick around for a minute or so to complete the survey. And lastly, if you experience any tech issues today, go ahead and hit the help button at the bottom of the screen. It's identified as a question mark icon. Back to you, David.
Thank you, Erica. Without further ado, I'd love to introduce Akash, who's the founder and managing partner of Momentum Advisory Partners. The firm is focused on a wide variety of M&A advisory assignments exclusively in the staffing and workforce solutions industry. Akash's track record of successfully maximizing value for owners of staffing businesses in a sale spans over 15 years. Prior to founding Momentum Advisory Partners in 2020, Akash spent over a decade in a leadership role with a prominent M&A advisory firm serving the staffing industry. As an industry leader with expert insight, Akash is also a frequent speaker on topics such as mergers and acquisitions, valuations, and related subjects at numerous prominent industry conferences, including Staffing Industry Analysts, Executive Forum, American Staffing Associations, Staffing World, and the TechServe Alliance. Without further ado, it's my pleasure to introduce Akash.
Thanks, David, for that great introduction, and a special thank you to the Advanced Partners team for putting on this webinar and inviting me to participate as a presenter. I think we've got a really great topic that you all are going to enjoy: mergers and acquisitions in the staffing industry. And so whether you're considering a sale at some point in the near term or in the long term, maybe you haven't really given a sale much consideration, you're more curious than anything, or perhaps you're just maybe looking to make an acquisition yourself. I think we've got a lot here for everybody. Here's a disclaimer I had to put up here for a few seconds, but here are the topics that we're going to be covering today. There's a lot of information that's going to be found here in the slides. So as Erica mentioned, we're going to be providing you guys with a copy of the recording and of the slides. So don't feel like you have to jot down every single note. If you miss anything, you'll be able to go back to any specific topic, spend a little bit more time. And I'd encourage you to use me as a resource. If there's anything that you wanted me to expand on in this presentation that we aren't able to get to here, or there's a certain topic that we weren't able to cover that you're interested in, feel free to reach out to me. We're going to provide our contact information a little bit later in this presentation, so feel free to reach out to me. So we're going to kick things off with an introduction to Momentum Advisory Partners. That's of course our firm. That'll be followed by the current M&A market overview in the staffing industry. Then talk about how staffing companies are valued, the types of acquirers in the staffing industry, who's making these acquisitions, so the different types of buyers. We're going to talk about that. And then lastly, we're going to talk about things to consider and how to prepare for a potential sale. And again, we're going to follow that up with some Q&A towards the end. So if you have any questions that come up during this presentation that you want to ask, go ahead and put those in the chat section, and I'll do my best to get to as many of those as possible before we wrap things up. So without further ado, let's get things started. So an introduction to Momentum Advisory Partners. So I'm Akash Taneja. I am the founder and managing partner of Momentum Advisory Partners. Momentum is a M&A, mergers and acquisitions advisory firm with a very specific focus in the staffing and solution space. So our primary focus is on advising and representing founders and owners of staffing and solutions businesses in a sale. And our experience covers pretty much every industry segment, all verticals. Here are just some transactions that we've completed in our history. And so we actually founded the firm in July of 2020, so just 3 years ago. And we are the leading M&A advisory firm in that time frame, that last 3 years, in terms of the number of completed transactions completed in the space. We actually just completed our 10th transaction about a month ago. I think there's really 3 key reasons for our success as a firm. First and foremost, it's our deep industry knowledge and experience in the industry. I've been doing this now for just a little over 15 years, so effectively my entire professional career has been spent doing M&A within the staffing and solutions industry. So first and foremost, our experience in the industry. Second would be, we know who the market participants are, we know who the buyers are, we speak with them on a very regular basis. We know what they're looking for. They share with us their specific criteria for acquisitions. We know how they evaluate businesses. And then third, we take a very pragmatic approach to both valuation and setting expectations for our clients very early on. So even before an engagement with the client begins, we are providing them with a valuation opinion of what's realistic, where their company is in the current market. So we're telling them, kind of what they, should be, what they need to hear as opposed to maybe what they want to hear. And I think our clients really appreciate that. We're arming them with all the information that they need, all the tools they need prior to an engagement so that they can make an informed decision. And I think our clients really do, appreciate that. Our main services are M&A advisory and valuation advisory. We're going to talk a little bit later what a formalized sale process looks like. We actually run very formalized sale processes for our clients. We're with them every step of the way from start to finish. We know they've never done this before, and they lean on us for our experience, and they trust us. We're a true partner in every sense of the way, I'd say. And also, what we're going to do for everybody that's in attendance that would be interested is we're going to provide a complimentary marketability assessment and valuation opinion for you on your company. So if that's something you might be interested in, we're actually going to go ahead and put that in the chat. Link to our website. We'll also share some of our contact information later in the webinar. So if that's something that might be of interest to you, please feel free to reach out to us and we'll get you set up with something. So enough about us. Industry and market insights, the M&A activity in the staffing industry. So every quarter we put together a quarterly M&A activity report. Basically covers everything that we're seeing in the market, observations that we've made. And so in Q2, global M&A activity in all industries, not just staffing. So global M&A activity fell 36% year over year. In the second quarter, so down pretty significantly, and that has a lot to do with a lot of the economic uncertainty. Inflation has remained high. The Fed is battling inflation by increasing interest rates since March of 2022. What that's done is that it's increased the cost of capital. It's made money more expensive to borrow, and of course that translates to financing transactions. It makes financing transactions more expensive. It's also tightened the money supply, so access to capital is a little bit tighter. Then specific to the North American staffing industry, M&A transactions were down both sequentially and on a year-over-year basis. We noted 27 transactions in Q2 versus 33 announced transactions in Q1 of this year and 39 transactions in Q2 of 2022. So certainly we've been a little bit on the decline here, but it should be noted that we're coming off a very high point. So in 2022, and you're going to see this on the next slide, we approached approximately 140 transactions in the industry. And if you look back on over the last 15 years, near 140 transactions is the most that we've seen in that time frame. So we're coming off a very high point. And it's not as if transactions have completely dried up. We have 60 transactions through the first half of this year already. The substantial majority of transactions continues to be in the as companies that are generally we focus on the most, spend most of our time on, is that lower middle market. An interesting observation that we made was that search and direct hire businesses actually recorded a third of all transactions in Q2. So that was actually quite surprising to us to see. That's not typical. But we have noticed an uptick in transactions so far in Q3. So through the first couple of months of the quarter, we've noticed, or we've observed that there's been 21 announced transactions so far. So we'll see where we end up in September to round out the quarter. But so far, we're starting to see a little bit of an uptick. And we have pretty regular conversations with buyers. And what they're telling us is that they're seeing slight decreases within their own business. Job orders are going down. And so they're just being a lot more cautious when it comes to acquisitions. It's not that they're putting their acquisition strategy on hold. More so, they're just being a lot more thoughtful, cautious. They're having a much higher threshold for the types of acquisitions that they'll make. We actually spoke with a very active market participant on the buy side, the Tandem Group. They've been very acquisitive as of late, and we talked to their head of M&A to just get his general thoughts on kind of what they're seeing in the market. And what they did note was that the number of what they would call quality transactions has declined in 2023, at least what they're seeing. So then I mentioned we'd be looking at M&A activity since 2010. So you can see there in 2022, we were approaching 140 transactions. Really, for the past few years, we've been very active as a market, except for 2020, of course, which was the peak of the pandemic. Through the first half, as I mentioned, 60 announced transactions. As the economic uncertainty begins to dissipate, M&A activity may begin to improve in the second half of the year. And that's our thesis. As the picture starts to get clearer, we think buyers are going to become much more confident in their acquisition strategies. And then in our report, we break down the number or the transactions by segment. And so, as I mentioned, search, we saw 1/3 of the transactions there. That was followed by IT staffing and healthcare staffing. IT staffing and healthcare staffing, usually the ones that we're seeing the most activity in, and we expect that trend to continue on. These were just some notable transactions that we observed during the quarter. So Jackson Healthcare, which is the #5 largest healthcare staffing organization, acquired LRS Healthcare. That was a pretty large deal. LRS, of course, is in the top 25 in terms of size in healthcare staffing. Seneca Resources acquired QED National. So we actually advised and represented QED National in the sale to Seneca Resources. Seneca Resources is a platform or portfolio company of a private equity firm called Camus Equity. And then Alcu, as one of the largest IT staffing organizations, they were recapitalized by New Mountain Capital being a private equity group. And recapitalized is really just a fancy way to say they were invested into. We did provide a case study for the QED National transaction that we advised and represented. But given the time, there are other topics that I really want to make sure that we're covering. So we're going to come back to this if we have time. It's going to be included in the slides, so you can take a look at it once you receive a copy. I'm going to jump over this and get to this next section, how staffing companies are valued. So there are a number of factors that go into what buyers are taking into consideration when valuing a staffing business. And these are in no particular order, but they're taking a look at the company's overall financial performance, the company's financial profile. So they're looking at historical, current, and projected financial statements. It's revenues, gross profits, EBITDA. For those that don't know what EBITDA is, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's effectively your net income before interest expense, tax expense, depreciation, and amortization expense. It's a proxy for cash flow. And also it's important to note that staffing businesses are valued based on a multiple of EBITDA. So they're taking a look at the entire financial picture, total financial health of the company. One thing that actually wasn't on here that I'll mention is company's customers. So the buyers are evaluating the company's customer base. What types of customers do they have? Are they private sector? Are they public sector? What industries are they in? What size of companies are they? Are they enterprise level companies, or are they small to medium sized businesses? Also, what type of relationship do they have with their customer? Does the target company have with their customers? Are they direct relationships where they have direct customer contact? Or are they working through a third-party VMS or MSP? Also, they're looking at, does the company have a high dependency or reliance on any one or small group of customers? So is there any customer concentration? So they're taking those things into account. Also, the company's market position, the market share and competitiveness within its industry, the types of services that it's offering, the type of skill sets that it's placing, gross margins, bill rates, etc. Also, identifying the target's unique strengths and competitive advantages over the competition. Another is cultural fit and integration, and you'd be surprised how important this is, really outside of the economics of the deal for really both parties, a buyer and a seller. Buyers want to take a look at how closely the companies align in terms of their culture, their core values, want to make sure that they're aligned on many things. How do they approach their business? How do they treat their employees? How do they work with their customers? How do they treat their billable consultants? So assessing whether the target's corporate culture aligns with the acquirer's values and organizational structure. Also identifying any potential cultural differences that may pose integration challenges. You can't expect to keep the entire company culture intact when you're acquired by a larger organization. You're going to lose some of that small company culture, but you want to make sure that the companies are aligned at least on the main points, right, and how they do business, how they treat their employees. So that's crucially important. Management and talent. For a lot of the companies in the lower middle market, the owners are very active participants in the business. So the buyers will take a look at how involved the owners are in the business. Do they have all the customer relationships? The owner is going to eventually transition out of the business at some point, and buyers want to know that there's a strong level or management team in place where the business does not decline and will not be affected upon the owners exiting the business. So evaluating the target's leadership and management team capabilities and experience. Also assessing the importance of key employees to the target success and their willingness to stay on after the acquisition. So retention of the key employees is key. Oftentimes a buyer will want to try to lock the key employees into employment agreements just prior to the closing or shortly thereafter the closing, most certainly. So management and talent. And then synergies and integration. So it only makes sense that a buyer would look to see where they're able to have some potential cost savings and efficiencies that would reduce costs and increase profitability. how will they be able to, leverage their operations to, decrease costs and improve the top line in terms of maybe they're leveraging their recruiting or delivery teams to the target company's business. So those sorts of things a buyer is evaluating. Valuation methodologies, really for the lower middle market, there's really only one that matters, and it's the top one. It's the guideline merged and acquired method, and it's basically based on comparison with other similar completed acquisitions, similar businesses, industries, and financial profiles. There are a couple others, valuation methodologies that a buyer might take a look at, but really the only one that really matters in the lower middle market is the guideline merge and acquired method. What are the multiple other similar sized, similar type of companies? What are those trading for? Valuation assumptions. So transactions are structured on what's called a cash-free, debt-free basis. And what that means is at the time of close, the seller will retain all of its cash in its operating accounts, less any interest-bearing debt. This would be lines of credit, short-term debt, or debt-like items. So the seller at the closing will retain its cash net of debt. It's also really important to understand how working capital is treated in the transaction. And we have a slide coming up here that covers working capital a little bit more in detail, because it's really important for sellers to understand how working capital is treated in a transaction. So included in a buyer's valuation, they are assuming that the company will be delivered to them with what's called a normative or sufficient level of working capital to continue to run the business. So what that means is, and it's really important to note, is that a seller does not keep its accounts receivables. A seller will not be collecting those accounts receivable to their benefit. That accounts receivable balance is factored into the buyer's valuation. So it's really important to note that, because oftentimes sellers believe that anything that they have in those accounts receivable balances will be retained by that. And that is unfortunately not the case. Working capital effectively is your current assets less current liabilities. It excludes cash and debt, of course, because this is a cash-free, debt-free transaction. The main components that make up working capital are, for a staffing company, are its accounts receivables less its accrued payroll liabilities. So we're going to talk a little bit more about that. Transaction structure. So many transactions have structure, i.e. they're not an all-cash deal. There is structure in many transactions, and effectively the less perceived risks in the business, generally speaking, equates to more cash that a buyer is willing to put forth at close. The typical or potential components, I should say, of a transaction would be cash, earnout, which we're going to get to. Earnouts are effectively a contingent payment, seller notes, and rollover equity. Rollover equity being a typical component for private equity transactions only. Earnouts. So earnouts have a very negative connotation, I would say. They have a very bad rap. Earnouts are effectively contingent payments, and they are dependent or based on future financial performance. So let's just use that as an example. Let's say a company was valued for $10 million, and a buyer was willing to pay 70% of that total valuation in cash at close. So let's say $7 million. And 30% of the valuation, or the total consideration, they're going to hold in the form of what's called an earnout. And the earnout is dependent on the company, the target company, achieving certain financial results. Now, there's so many different ways that a buyer can structure an earnout. Oftentimes what they do is they try to include some type of growth in the business to achieve the 30% that was in our example. But typically how we structure earnouts, if there is an earnout in a transaction, is we want the seller to get the full credit for the full valuation to earn the full earnout for just maintaining results through the course of the earnout period. In terms of the earnout period are typically anywhere from 1 to 3 years. I've actually never seen one that's been done for 3 years, but I have heard it typically 1 to 2 years in length. And they can be structured to obtain or achieve some upside. So if the company grows, there's ways to structure an earnout to achieve some of that upside growth. Seller notes wasn't on here, but seller notes is pretty straightforward. It's basically the seller is holding the note, seller financing. So pretty straightforward. Another component of transactions, and this is really specific to private equity. Private equity has been making some pretty significant investments into the staffing industry over the last several years. So it's important to note kind of how they structure their transactions. Usually it comes with a requirement for the owners to what they call rollover equity. So let's go back to our example of $10 million purchase price. The private equity firm is acquiring 100% of the shares or the assets of the business, but then asking the owners to roll back a certain portion of the total consideration. So it could be anywhere from 0 to 40% of the total consideration that they ask to the target company owners to roll over, and it shows confidence to the private equity firm. That's oftentimes why they require it. It shows confidence in the strength or the owner's confidence in the future of the company. And the benefit to rolling over equity is private equity, obviously, they are in the business to buy businesses at one price and then sell them some years later for a multiple. And by rolling over equity, the owners get to carry in on some of that upside potential. So they get what they call a second bite of the apple or a second liquidity event. Potentially their investment hopefully is worth somewhere in the a multiple of what they invested in. So we talked about EBITDA and how companies are valued on a multiple of EBITDA. It is important to note that if there are any one-time expenses, non-recurring expenses that the business realizes that upon closing the buyer will not experience, those would be considered adjustments or add-backs, and those get added back to EBITDA. So every dollar of add-backs that's added back to EBITDA equates to a multiple of whatever the buyer is looking to pay. So for example, if a buyer values a company at a 5 multiple, every dollar of add-backs equates to $5. Some common examples of adjustments would be an owner's personal expenses, non-recurring professional expenses. It could be one-time legal expenses that come up, startup costs for implementation of the front or back office technology. So perhaps you might be doing like a bullhorn integration and there's startup costs associated with that. Those would be considered add-backs or adjustments. Charitable contributions, any expenses that are outside of the ordinary course of the company's business would be considered to be add-backs. So it's important to note, though, that buyers look at add-backs with a very fine-tooth comb. As I mentioned, they are paying a multiple for every dollar that is added back. So they take a look at those very carefully to make sure that they are actually valid adjustments or add-backs. Also, no credit is given for potential cost cuts post-acquisition. So they're not going to give a seller any credit for any potential synergies that the buyer is bringing on. They're not going to pay you for those cost reductions or synergies. Other considerations, buyers typically are looking to retain the key management and owners if the owners are actively involved in the business for some period of time post-closing. And also, seller and buyer will coordinate to ensure the most tax-efficient structure. So we're going to get to this a little bit later, but you're going to want to make sure that before you engage in a potential sale, that you're talking with your tax professionals to see what the tax implications are. There are many different ways to structure a deal, and they all have different tax implications. So it's important to work with your tax advisor to get that information. So working capital. I talked about working capital and its importance, significance in a transaction. So working capital, it is a financial metric that represents the operating liquidity and short-term financial health of a business. So it gauges a company's ability to meet its short-term obligations. And as I mentioned earlier, the simple calculation for it is your current assets less your current liabilities, excluding your cash, excluding debt and debt-like items. For a staffing business, it's effectively your accounts receivable less your accrued payroll liabilities. It's calculated from the balance sheet. And again, a buyer is assuming in their valuation that the company will be delivered to them with a sufficient or normative level of working capital. And so the working capital that is delivered is actually a negotiated item. It's agreed upon by both buyer and seller during due diligence. So it is a negotiated item. From a seller perspective, you want to make sure that you're not over-delivering on working capital, because over-delivering is effectively taking money out of your pocket. It's leaving money on the table. And a seller or a buyer wants to make sure that there is sufficient working capital in a business so that they do not have to make any additional investments into the business at closing. Here's a simple working capital calculation. Again, I mentioned that the main components are accounts receivable liabilities, but also from a current asset perspective, it includes security deposits and prepaid expenses. But that's a pretty simple, straightforward calculation. It's what most staffing companies will look like. The different types of acquirers. So strategic buyers. So these are other staffing organizations. Company acquires with the primary goal of achieving a specific strategic objective. So these are some examples here you see of strategic buyers of staffing companies. Then you have what are called financial backed strategics. So these are companies that have an investment in them or are backed by a financial sponsor, primarily private. I mentioned that private equity has made some pretty significant investments in the staffing industry over the years. These companies here to the right on the bottom all have investments made into them by private equity. And so these financial backed strategics will make additional acquisitions. They are called add-on acquisitions. They focus on identifying acquisition targets with strong growth potential, operational synergies, and businesses that align well with their overall investment strategy. So ultimately, the strategic buyer, in the sense of the financial backed strategic, is making the decision whether or not to pursue a particular add-on acquisition, and the private equity group that is backing them is financing the transaction. Then you have pure financial buyers or private equity buyers. Private equity is an investment fund which invests in and restructures private companies with the goal of ultimately realizing an increase in the value of that investment. So they're raising money from institutional and high net worth individuals to create these investment funds. The investment periods typically range anywhere from 3 to 7 years. Of course, there are outliers. Overall idea is to buy low and eventually exit that business at a multiple for what they paid for it. And as I mentioned earlier, that often the private equity buyers require the selling owners to invest alongside of them in the form of rollover equity. And these are just some examples of private equity firms that are active in the staffing industry. So things to consider and how to prepare for a potential sale of your business. So it's obviously never too early to prepare for a potential sale, to start thinking about it. And we would, suggest or recommend getting a valuation, on a somewhat regular basis. Whether or not you're considering a sale, it's really going to tell you a lot about your business. So understanding the true value of your business is vital for making informed decisions, maximizing growth opportunities, and securing your future success. It's going to tell you kind of where you are, where you're positioned in the current market, areas that you can work to improve. If there's certain areas that buyers view as more attractive, maybe there's certain things that you can implement in your own business. So you're going to learn a lot from a valuation. An evaluation from somebody that has experience in the industry that you work in, that they know what the market multiples look like, they know how buyers evaluate these businesses. So understanding the value of your business is of key importance. Of course, planning for the future, making informed strategic decisions, optimizing business performance, negotiating from a position of strength, knowing where you are, and mitigating risks and uncertainties. Preparation is key. Assembling the right team of advisors is critical to achieving success in an M&A transaction. So working with an M&A advisory firm that has specific industry experience in doing deals similar to your company is vitally important. Working with your tax and accounting professionals, so optimizing your financials, minimizing tax liabilities, and ensuring financial records are accurate and transparent. Want to make sure that you have your financial house in order prior to engaging in a sale process. There's a lot of information that buyers are going to request, and it's helpful to know kind of what those things are and to plan for them so that you have your information in order and readily available. Also, from a tax perspective, you want to know what your tax liability would be in the various types of ways that transactions are structured. So working with a tax professional that is familiar with how these transactions are taxed. Legal, of course, legal, and this isn't just your attorney that works on corporate matters. This would be an attorney that is very experienced in M&A transactions, preferably if they have expertise or experience in the staffing industry. Within a transaction, the definitive purchase agreement, so the closing document, they're pretty lengthy. They have a lot of information in there, and you want to make sure that you are fully protected. You're going to be making a lot of representations and warranties on your business, and you want to make sure that you have a professional on your side that is familiar, has experience in completing M&A transactions, because it's gonna really help you in the long run. So mitigates potential legal risks, provides expert negotiation support, and ensures the deal structure aligns with your objectives. So we talked about that our firm, we run a very formalized sale process. A typical sale process will take about 6 months on average, could be anywhere from 6 to 8 months. And this is really kind of how a typical formalized sale process looks like. So usually in the first part of the process, we're working on preparation. So we're gathering diligence information, gathering information on the business. We're preparing our marketing documents that will be going out to the market with. We're developing strategies for maximizing enterprise value. And we're putting forth a prospective buyer list for our clients to review. So that is the first section, which is the preparation section. Then the marketing section is about 2 to 3 months. And this is where we're actually going out to the approved buyer group. We're setting initial calls, we're gauging their level of interest, we're fielding their initial offers, we're negotiating with them, and we're selecting the one that we want to enter into a letter of intent with them and provide exclusivity. So that's the second phase of the transaction. And then the third phase is the due diligence to closing. So once a letter of intent or an LOI is signed, we're providing that buyer with a certain amount of exclusivity where we're not going out and shopping the deal anywhere else. This is where the buyer is doing a good portion of their diligence. So they're providing to us a pretty significant or substantial list of requests that cover pretty much every aspect you can think of your business. And so we gather all that information for a buyer. They review it. They begin with what's called their quality of earnings review, and that's really where they're validating the numbers that we have provided to them. So kind of like think of it as an audit of the financials that we presented to them. Once they've gone through their diligence and they feel comfortable, then they deliver to us a definitive purchase agreement. And this is the closing. So definitive purchase agreement along with any other ancillary documents. Those documents are negotiated. And so those two items are included: due diligence, legal review, purchase agreement review in that final stage. So typically from 6 months from start to finish. And I think, Erica, if you're okay with it, I think we've gone through much of the presentation. If there's any questions that you saw come through, I wasn't really paying attention, but is there any questions that came through that you want to lob over? I'll do my best at addressing them.
Yeah, we got a lot in, so we will try and address as many as we possibly can in the next 15 minutes. That was great, Akash. Thank you so much. First question, when it comes to mergers and acquisitions, what role does confidentiality play, and how can I protect sensitive information during the sale process?
Yeah, that's a great question. So confidentiality, obvious, is key. If you're undertaking a sale process, of course, you don't want anybody within your organization to know that you're engaging in a process. Maybe you want to allow certain people, but that's completely up to you. So confidentiality, of course, is key. Also, when going out to buyers, we're having them sign a confidentiality agreement before they receive really any materials. So we make sure to run a very tight process where buyers understand that this is a very confidential, the information that we're providing to them is very confidential in nature, that they're not reaching out to anybody within the company's organization. And so we run that to be, it's super highly confidential. So, it's of key importance, and we don't take that lightly.
Great, thank you. This question reads, should it be considered normal business practice for sellers to not allow buyers to talk to clients and employees prior to the closing of the acquisition?
Yeah, so buyers typically will want to, at some point prior to closing, to have some type of interaction with the key people within your organization. They're also wanting to speak with your key customers. Now, that doesn't always happen, and it's certainly something that we leave for the very end of a transaction if it absolutely must be done. Some buyers have that as a condition to closing, that they'll need to speak with the top 1 or 2 customers, and they'll make that as a condition to close. But we make sure, if that is the case, first, we don't want that to happen pre-close in the first place. But again, if the buyer is insistent in making that as a condition to close, we leave that for the very last item. Sometimes it could even be, in the 1 or 2 days that are leading up to the closing. And if those interactions do take place, then the seller is very involved in those, in terms of what will be discussed, what can be discussed, what can be shared. So the seller has a lot of input into it. We always try to push those out post-close. Unfortunately, sometimes with certain buyers, they just aren't comfortable, right? They're making a significant investment into the business, and they want to have some clarity around customers and key employees. So sometimes it's just not practical or a way around it.
Gotcha. Thank you. This question was asked several times. What do you define as lower middle market in terms of annual revenues?
Yeah, sure. So I think people define it various different ways, but I would really define it as companies with annual sales of less than $100 million. The majority of the market really is in that space, but it could be anywhere $100 million or less in sales, $50 million or less in sales. It's really defined a little bit differently. How we define it is companies with annual sales of $100 million or less.
Okay. A few more. Are there any companies or industry groups that do not have multipliers? And how would multipliers typically apply to staffing businesses specifically?
Yeah, so all things being equal, generally speaking, staffing companies are valued based on a multiple of EBITDA. The multiple can be, a pretty wide range depending on the type of business, the size of business, all the factors that we talked about earlier that buyers take into consideration. And so they are applied based on using a multiple of EBITDA. And that's pretty much with all staffing companies, unless there's a company that, is not profitable, for whatever reason. In those cases, oftentimes a multiple is applied to gross profits, and those multiples will, of course, be different since gross profits are larger than EBITDA.
Okay, thank you.
I hope that answered.
What was that?
No, I was just saying, I hope that answered the question, but of course, if there's any follow-up, anybody feel free to reach out to us if they want us to further expand on that. It's a great question.
We'll do maybe two more. This question reads, why do you think there is an apparent lack of buyer interest in the accounting and finance staffing verticals? Do you see that changing anytime soon?
Yeah, so it's not always because a specific segment didn't have much activity means that there are buyers that are not looking to acquire companies that are in that specific industry or vertical. I would say, in the conversations that we have, there are a number of buyers that are looking for quality accounting, finance transactions. There's just not really many that are available. I think it's just as simple as that. It's not that there's a lack of interest in those segments. I actually think there's quite a fair bit of interest given the gross margin profile for a lot of accounting and finance companies. So just because a specific industry doesn't have a large number of completed transactions, I wouldn't say that's reflective of the level of interest. I just don't think that there's many available quality transactions in that space.
All right, and I think we have time for one more. If we did not get to your question, we can address it in post-webinar marketing emails. But for the last one, as it relates to overall valuation, how much does permanent placement factor in, if at all?
Yeah, that's a great question. So all things being equal, generally speaking, the more perm or direct hire in a business, the less valuable it becomes from a buyer perspective. And the reason for that, again, it's a generalization, but the way a buyer typically will view permanent or direct hire business is obviously it's not recurring. So it's kind of a one-time thing. And unless they see a lot of consistency in that business, they effectively view it as they are paying for something the benefit of a very profitable service line of business. Obviously, perm direct hire is straight to the bottom line effectively. They don't want to overpay for a business that's not going to be there tomorrow. So generally speaking, all things being equal, permanent business. Now, that's not to say that if you have perm or direct hire in your business, that buyers, but I would say the less, the better. Certainly, the minority of your business in perm or direct hire.
All right. Should we take one more? I think we have a little bit of time. You okay with that, Akash?
Yeah, please. You haven't asked the question,
Okay.
which I'm sure a lot of people here are. You haven't asked the question, but I think a lot of people are probably acutely interested in where are the current market multiples. So I can address that. The short answer of that is it really does depend, and of course, on a number of factors that we talked about, size for one thing. But I would say if I had to provide a range, it's a pretty wide range. We could see multiples anywhere from, on the low end, 3.5 times, upwards of like 10 times. And again, it just depends on a significant number of factors. Usually the businesses that generate the higher multiples, you do get a premium for size. So as you start to get a lot larger, in terms of both revenues and profitability, that multiple begins to.
All right. Thank you so much. That was wonderful. All right. Well, as I mentioned, if we did not. Yeah, if we not get to your question, we are happy to address them. Any question that was submitted during the webinar, we will answer in post-event follow-up via emails from Advanced Partners. You can also reach out to Akash. His contact information is on the screen. Thank you so much for joining us.
Yeah, really appreciate you guys putting this on, Erica and David, and inviting me to participate, be a presenter. Really appreciate everybody that's been in attendance today, taking some time out of their busy Monday to join us. I know a lot of you guys have questions. I was seeing them come up in the comment section as I was working through the presentation. Unfortunately, I couldn't glance over, but I did see them. If there's anything that we didn't cover or you had a question on, again, like Erica said, please feel free to reach out to us. And again, we're going to go ahead and provide a complimentary marketability assessment and valuation opinion for you. If you're interested in something like that, information is here on the screen, and we'll be happy to so again, I really appreciate it. Thank you all for your time.
Thank you.